Welcome to our third lesson in our general accounting journey. This is Oliver. I am your learning facilitator, and I'd like to provide you with this supplementary resource to hopefully enhance your comprehension of the concepts in this course in general and this chapter in particular. We are going to add to what we have already done. And so for chapter 3, I have captioned it as going from journalizing to posting or journalizing before posting. So what do I mean? Well, remember that we are in the accounting information process. We are providing information, useful information to users, and we do that by analyzing events to determine if transactions have occurred. We classify and record those transactions, then we summarize them in financial statements, and we provide the report to interested users. In chapter 2, you may remember, we recorded our transactions using what we refer to in general terms as T accounts because they resemble the letter T. So we have a left side and we have a right side. And remember we said that we record our give and a get in the same way. So every time we have a get, it goes on the left side, and every time we have a give, it goes on the right side. But the impact is going to be dependent on the category. For example, cash is an asset. When we record a get, it goes on the left, but that's going to increase the asset. When we have capital and we record a give, it goes on the right side. A give would also have been recorded over here, but the impact is going to be different. So this give, because it's in equity, is going to increase the capital. If I were to record a give in my cash, it would go on the right side because that's where give is recorded, but the impact would be a decrease if it were asset. So we increased the cash and we increased the capital. Down here, similarly, we increased the asset and we increase the liability. So that's what we did in chapter 2. We used T accounts to record debits and credits, and we showed that we have an increase or a decrease depending on the category and the side on which the amount is recorded. We're not changing any of that in chapter 3. We're introducing instead another resource, another tool to help us with the recordation of transactions. It's called a general journal. Why do we need this? Well, we need this because it allows us to have all of our transactions recorded in a single place, and we can easily reference that information at a later date to recall or remind ourselves why that entry was made. So for example, this is how the entries that I have here would first have been journalized. We have the date, we have the name of the accounts, cash, all right, and capital. We are debiting cash with 25, and I indicate the account number. We are crediting capital, and I indicate the account number. Little convention here to alert you. When you're making a journal entry, do your debit first and then your credit. And the convention is to indent the account name that is being credited. Doesn't mean anything is going to go wrong if you don't. That's just the way that accountants expect to see the information presented. So if you have 2 accounts to be debited, debit the 2 accounts first, then you make the credit. And of course, your debit should be equal to your credit. Once you have journalized, then you have to do one last piece here, which is to provide a narration, which is a brief explanation of what it is that you just recorded. Why did you make this entry? So you give as much information as possible. This becomes very useful if a year from now, 5 years from now, you're wondering, why did we make this particular entry? This tells us, right? We received a check. There's the check number. and it was from the owner, and we deposited into bank account number, and we indicate all of that. Once you have journalized and provided your narration, you would then post to the accounts. Notice also that we're now introducing one other piece of information, which is the account number. Then we do the same thing here, debiting supplies, because we have a get supplies of 3,000, and we gave our promise that we're going to pay this in the near future, so we made a credit. And again, see my narration here, which helps to provide useful information as to why this entry was made, what gave rise to this transaction. We received an invoice, there's the invoice number, and it was from this particular supplier, and it tells that we need to pay by August 15. If we pay within 10 days, we get a 2% discount. Otherwise, we're expected to pay the net in 30 days. So the narration is supposed to provide us with that memory jogger, if you will, but more importantly, an explanation as to why that entry, that transaction was recorded. Also notice that we're getting our information, as I told you from lesson 1, from source documents. So it could be a check, it could be an invoice, it could be a receipt, but all of that information gets documented. So we journalize first. Step 1 is to journalize, and then you post. And of course, whatever you journalize, how you post should be the same. So if you say debit this account, then you need to make sure it gets debited to that account. In an automated system, these columns would be tied to the account in question. So for example, if you put 100 here and that's the a valid account number, it would most likely bring up the name of the account. If you were to enter an account number and that account does not exist in the chart of accounts, there would be a flag, that says account does not exist or something like that. So the automated system does help when you are using journals. And so most accounting software, they require the journal, and then from there they automatically post to the ledger. As we have done in previous problems or previous lessons, we select a problem that is going to be used to illustrate the concepts. So in this one, we're looking at problem 3.3b, which means, again, you were assigned, or you have been assigned 3.3a. We have our chart of accounts. Notice each has an account number, and you will learn after a while, depending on the company that you're with, the organization. For example, if you're at a bank, that the digits are, each digit may be significant. For example, in this particular business, it seems all assets begin with a 1, right? All liabilities begin with a 2. Each equity account begins with a 3. Each revenue account begins with a 4. Each expense account begins with a 5. So you can tell just by looking at that first digit where the account belongs. But that's just one convention that could be used. There are so many sophisticated ways of numbering your accounts in your chart of accounts. Then we have the transactions. Just like we did in the past, every transaction has a give and a get. And so we're going to determine what the give is, what the get is. For every get, we're going to debit. For every give, we're going to credit. The other thing that is different about this problem is that we are not starting from the beginning of the business. We are picking up after some time has passed. So we're doing this for the month of July, and they're giving us balances from the previous month, the month of June. And so when we get to the ledger, you will see that those beginning balances were already recorded for you in the ledger. But we're going to post after we have journalized each of these transactions for the month of July. Here then is the general journal. You can see the different columns titled, the date, the description, the post reference, the debit, and the credit. And here, of course, we record the date, July 1, and the transaction involves equipment and cash and accounts payable. Notice that the debit is recorded first. This is the account number associated with that from the chart of accounts. We're recording the get of the equipment, 6520, and then we have two gives, right? We have a give of cash and we have a give in terms of a promise to pay in the near future. So we are saying credit this account, the cash account, with the amount of the check that we paid, and then credit accounts payable with the amount that we still owe, but we promised to pay in the future. So we gave our promise, so that's the give. So we have two gives and one get, but notice that the give is equal to the get. Debit, which is the get, equal the credits, which are the give. And now you can see with the narration how helpful this is, because it tells you. And so this is somewhat of an art form, but over time you get an idea as to what the narration should be. Basically, it's whatever information is going to help you to remember or document why that particular transaction was recorded. So it indicates that we bought lab equipment, we bought it from this supplier, and this is the invoice number, and this is the check number. So we can easily research this if we so choose. Same thing we do for the next transaction. It was rent expense, and the narration tells us exactly what it is. Why am I debiting rent expense? Because this is a get. We receive the services of the landlord, the use of the building, so we pay the rent, and this is our give, so we credit cash. And you do the same thing for each of the transactions. You go through and you record, journalize all of your entries. Here's one that we haven't seen before, where we are returning an equipment, a portion of the equipment that we have bought. So we are decreasing accounts payable and decreasing the equipment. So notice that we are giving the equipment back and we're getting a reduction in the amount that we owe to that particular supplier. And again, we have our narration which tells us what happened. We're returning damaged equipment, and this is the invoice number, and this is the credit memo that was issued to us or to the business by the seller of that equipment. Once you have journalized all of your transactions, your next and important step is to post. Again, notice that we had a beginning balance from a previous month. So that's your beginning balance. And then you have each of the journal entries posted. And you can tell very quickly where in the general journal that particular transaction is located. So if you wanted to know why this credit for 1520 was made, you can just quickly go to the general journal and go to page 21, and you should be able to find this particular entry. Again, whatever you see here is based on what was recorded in the journal. So the journal, we indicated credit cash with 1520, so that's what we did for that July 1. And then July 3rd, we had another credit, and so on. Notice that each credit is decreasing my cash, because that's a give, and each debit is increasing because that's a get to an asset. And so we record all the give and the get, all the debits and the credits, and we end up with $929 left in our cash account. Same thing happens. By the way, this is called a running balance because after each entry, a new balance is determined or calculated. So you make the entries in these two, and then the balance, it says balance, so it's a debit balance because that's the normal balance for your cash. You can have a credit balance, by the way, in your cash account, but that would mean that the bank allowed you to overdraw your account. So let's say we had $920 and then we wrote a check for $1,000. We would have what, a $71 overdraw on our account, which if the bank approves, then the check would be paid. But the normal balance is a debit. That's true for assets, that's true for expenses. So each asset should have a debit balance. So you can see that is the case for each of these. Same thing here, additional assets. All of these are just posting from the general journal. So the key thing is to know what to do, determine your give and your get, journalize, and then whatever you journalize, you then post accordingly. Some businesses post every day, some post once a week, some post instantly. But the bottom line is you journalize and then you post. Once we are finished with journalizing and posting, now we want to verify the accuracy of our ledger. And to do that, we use what is called a trial balance. As I think I shared with you in a previous lesson, it's called a trial balance because it's a trial, a test of the balances in your ledger. So you take the balance from each account, and if it's a debit balance, it goes in the debit column. If it's a credit balance, it goes in the credit column. So everything looks normal here. By that I mean all my assets, they have debit balances as they should. My liability has a credit as it should. The capital has a credit as it should. And this contra equity account, which is the drawing, has a debit as it should. So assets first, then liability, then equity, then revenue, and then your expenses. This particular trial balance doesn't show it, but it's not unusual for a column over here on the left to have the account numbers. So you would see the account number maybe coming down on the left side here. But it's not indicated or required in this particular problem. And so notice that at this point, we can now prepare our financial statements if we so choose. Again, remember the format for your labeling of each report. This is a trial balance. So you put the who, which is the name of the entity, the what, which is the name of the report, and the date. Why July 31st? Because we're showing the balances on that day. Not over a month or a year. On this day, in whatever year, these are the balances. And so we can now prepare our income statement by taking the revenue and adding all the expenses, subtracting. We are going to get most likely what? A net income, because these do not equal anything close to 14,000. So there will be a net income, which will then be added to the capital, and we would deduct the withdrawal. All of that would occur, as you may remember, from Chapter 2 in the statement of owner's equity. And then in the balance sheet, we would show all the assets, show the liabilities, and then show the balance from the statement of owner's equity, which would be this balance, opening balance, plus the net income from here, minus the withdrawal for the period. Again, I really hope that this proves to be beneficial, and if you have any questions, please reach out to me for assistance.